Welcome to the weekly video update, where I'll go over the action in the market for the week of October 2nd through the 6th, and then we'll see how things are looking for the week of October 9th through the 13th. As soon as I turn on my laser pointer, we had a slight up week for the S&P. We've had a couple of down weeks, and now we had a slight up week. We're still negative in the daily version of the charts that we look at. We're still showing some more negativity in the weekly charts, but we're also possibly seeing some improvements on the daily charts, and I'll try to point those out as we go through the weekly charts. But we're still negative overall for right now. So before I get started, there is a PDF that's available in the description below every video that I post. I was using a shorter URL to that. Well, YouTube started to delete those for some reason. And so now I'm posting the whole URL to my Google Drive. That really doesn't matter to you. You still have access to the same file. Some folks like to download the slides and the charts that I use so they can kind of follow along as I talk about things. Also, please note that every day on the community tab, and I can only do this on the YouTube channel, I post the pivot points. These are set before the day, the week, the month even happen. And we can know, and especially on the 10-minute intraday chart, these tend to be very influential. A lot of the algorithms and program trading that goes on that's not done by humans, it's done by machines. They follow these pivot points very closely. And it's just amazing to me day after day after day, especially on that 10-minute chart, how these will act as either support or resistance. And so what I do before I post each daily video, I also post the established pivot points for that particular day. And I also produce a daily chart, which shows you the pivot points for that particular month. I do have a private Facebook group that you're welcome to join. There's not an awful lot of activity in there. I'm pretty much the only one that posts right now. There will be a new poll that's posted after I get done with this video. I'll show you the results of the latest poll coming up here. I do really check YouTube comments pretty much every day. I have to go through and delete a lot of comments that are put there by bots, or they're just crap comments, as I call them. I don't mind regular comments from real people. If you have something you want to take to task with me, that's fine. We have a difference of an opinion. Maybe you agree with what I'm saying. Maybe you disagree. I have no problem with that. It's the garbage stuff. And the way I do the videos, I don't get an awful lot of comments. And the comments that I do get, I'm very thankful for. And I really try to respond to those quickly and treat those with respect. But the garbage ones, I like to have go away very quickly. And I also post these same videos on Rumble. So if you're on YouTube and for some reason you can't find me, you can jump over to Rumble. If you're on Rumble, you can also come over to YouTube and watch the same video there. All right, let's go back and talk about this week's session. We were up 0.48% for the week, which may not seem like all that much, but it was quite a turbulent week, and especially after coming off 2 down weeks. We did have above average volume. We're seeing more participation taking place. The only day that we saw weaker than or lower than average volume was on Thursday, and that was the day before the employment situation report came out. We are more negative with the technicals, but there are some positive things to latch onto, and I'll point that out. And I'll also try to point out the differences between the weekly charts and the daily charts. It's about inflation, interest rates, growth concerns. What's the Fed going to say? What's the Fed going to do? There's a whole mess of other things going on in the world right now, but the market is really fixated on itself for the time being. And the condition of our trend, it is a weakening trend. We're dropping below the moving average. The red line is on top, so we default to the negative for the longer term weekly trend. We are seeing a little bit of an improvement on the daily charts, but we're still negative there also. So for the week, the Dow was down 0.3%. The NASDAQ was up 1.6%. The S&P was up 0.5%. And the small caps were down 2.2%. We're still seeing a lot of weakness in the small caps, and I'll show you some charts later on. And that's not good. In a healthy environment, we want to see the small caps doing well. So just some bullet points. The S&P and the NASDAQ had gains while the Dow and the small caps were down. So on an index level, we were mixed. The mega caps, which have been really holding the market together in 2023, they continue to outperform, and a lot of the gains that we saw came from them. The energy sector was really down. It's been bouncing back lately. Well, this past week it fell, and oil, which has also been really going up and is part of the energy sector, it was up around the 90 level. Now it's dropping back down to 83.04, at least based on Friday's close. Interest rates were up for the week, and that's still putting pressure on stocks. The dollar was virtually unchanged, but down slightly. Both the rise in the dollar that we had been seeing and the rise in interest rates have been really putting pressure on stocks. The employment situation report, which is probably the most important economic report of the month, it came out in Friday's session, and it was stronger than expected. There was initial negative reaction to it. The headline number, the number of new jobs that were created, was pretty much double what they had expected. And that freaked out the market. And then we went down after the open, but then we spent a lot of the day on Friday coming back and actually getting above the 4,300 level. We did hit the upper resistance where we set a previous high back in August 2022, and that is where things pretty much topped out. Kevin McCarthy, if you want to talk about politics, he was removed as Speaker of the House this past week. That's one thing, but now it's like they don't really have a plan for where do we go from here. So we'll just have to see how that ends up playing out. We're also keeping an eye on the VIX. We're coming more into the middle part of October, where on an average basis, sometimes we tend to top out around now, at least on a historical basis, before we start coming down. Now, when the blue line's going up, that means that stocks are going down. When the blue line's going down, that generally means stocks are going up. We're also keeping an eye on inflation. Now, we're going to get PPI and CPI in the upcoming week, but we're comparing the period right now to what happened from 1966 through 1982. The blue line is what already happened back in the 60s and in the 70s and 80s. The gold line, and it hasn't been updated in a little while here, but this is suggesting that we might still see more of a decrease in inflation going forward. The only problem with that is look what happened afterwards. And if you grew up in the mid to late 70s, you probably experienced this real spike in inflation, and that was stagflation, where we had no growth but really high inflation at that time, and it was a very difficult time before we finally saw inflation start to come back down in the early to mid 80s. We're also watching this. This is some research put out by RenMac, and I found this chart on Twitter. They did some studying, and they have come to the conclusion that when the 10-year yield is above 4.02%, that's when it starts to pressure stocks. Well, we closed on Friday at 4.78%, so we're well above that, almost 0.75% above that, and so that's also putting some pressure on stocks. Looking at our poll, going back to a week ago, the government shutdown appears to have been avoided for now, but the UAW strike continues. Do you feel that this will have an impact on the economy? 56% said yes, 44% said no, and I just threw in there kind of, because it's like, will it really have that much of an impact? It may have a little bit, but not very much, but nobody answered that. Then oil, interest rates, and the dollar, which a week ago, they were really going up, and they've been pressuring stocks. Do you feel that this will stop or continue? 33% think that it will stop soon, and it really hasn't stopped yet. So the folks that said it will keep pressuring stocks at 67%, right now they're still putting pressure on that. Yeah, we saw oil come down this past week. We saw interest rates come down on Friday and on Thursday, but we need to see more than just 1 or 2 days. We need to see a trend either higher or lower. And September is finally over. We're into October, which is often positive, especially when you compare it to September, because September is the worst month of the year, but October can also be very negative. We had a lot of crashes, 87, 2008 or so, 1929, a lot of bad things have happened in October. Do you feel October will be positive or negative by the end of the month? 33% said will be positive, 67% said negative. And there is something to be said for that. I'll go through some of the seasonality charts later, where we might get a little bit of a bump as we come into the middle part of October, but on an average basis, and looking at this historically, yes, we often see some weakness especially during a pre-election year going into the latter part of October. It's November and then into December, which is typically where we see the nice gains going into the end of the year. But you never know for sure. We may have started already, or it may be delayed and not ever happen. We're just dealing with probabilities here. We don't really know what's actually going to happen. The S&P has seemingly found support at the 200-day exponential moving average, and we were dealing with that again in Friday's session, and we dealt with it numerous times throughout the week. This is not typical. Most folks pay attention to the simple moving average. That's the big one that gets all the headline. Well, this is not typical for a support level. Do you feel that the S&P will climb from the exponential moving average or fall down below it? 40% said we will rise above it, which we ended up doing in Friday's session, where 60% at the time this poll was conducted thought that we would end up falling down below it. And we did for a couple of days, but then in Friday's session, we were able to come back above it. All right, and then I have to hit the button quite a bit. I do have a few Isabel Net blog charts to show you. This is a chart that I've shown for about 3 weeks now. This is just showing seasonal patterns from 1990 up to 2022. So it's a little bit outdated. We're coming more into October now, where a lot of times we will historically see some weakness before we see things begin to climb. Now, other charts are going to look a little bit different than this. It seems like you could get a standard answer from this, but it depends on, like right here, they took out July 8th, 2009. When you start toying around with these things, you can come up with pretty much any results that you want. We're also looking at some Carson research, and I'm going through this on the daily video, where we're coming into October, where we might be seeing that bounce part of this, at least on a historical basis, before we end up seeing some weakness going into the latter part of October. And we're wondering, is that going to be the same this year? Here's another chart that I used a week ago. We're a little bit more forward now into October, where we're not right here where it's saying that we're a week gone by now, but we often see some weakness in October. We tend to flatten out in October, and then near the end of October, we see some more weakness before we see a real strength going into the end of the year. One of the reasons that we can use to justify for stock prices to go higher is if you look from the left all the way over to the right, you see an increase in the earnings per share going forward, and that's justifying higher stock prices. Then we also had the employment situation report that came out. One thing to be aware of when you look at employees, that's in temporary services, that's the red line here. And we're dropping down here below this red line, which in the past, that is often signaled a recession. You can see these gray areas. We drop below the red line, recession. Drop below the gray line, recession. Well, is that going to happen now? This is something pointing in the favor of the, yes, we might in fact go into a recession. But we have just as many charts that are suggesting that we won't go into a recession. And that's why we're seeing a lot of debate going back and forth about this. Some FactSet earnings blog posts. There was only one this past week. It said the financial sector, this is a preview of their earnings for the third quarter in 2023, where this is what we're looking at now, where they are showing some profits. Remember earlier in the year, we had a lot of banking problems, and we're still wondering, is there more to come with that whole mess? And then looking out into the fourth quarter, it goes down, but it's still positive, and then it goes down into 2024 before it starts to go back up. That's pretty much all that they were talking about. We're kind of right in between earnings season right now. We're getting near the end of one earnings season, and we're getting ramped up for the beginning of another earnings season. So it's kind of slim pickings at the current time. Looking at the intraday chart, going back to Monday, where we had initially just a choppy open after the weekend, which is kind of strange. Usually we see a gyration. We went up to the daily pivot and then ended up going down. Tuesday ended up being quite negative. We ended up going quite down, and that's where we set the low for the week. We chopped around on Wednesday, but then had a stronger close. And then we just made a big U shape on Thursday on lower than average volume as they were waiting for the employment situation report. It did come out hot, and so we gapped lower, but we came down to this 42.25 area, set a bit of a base here. We never made it down to the 200-day simple moving average, before just jetting off and then finishing just off of the August 2022 high before we saw some weakness going into the close. So for the week, we had the NASDAQ 100, the S&P, they were positive, but then you had the Dow, the NYSE, the mid caps, and the small caps ended up being down. Now, this just measures the 5 trading days for the past week. It doesn't go from Friday to Friday. It just goes through Monday through Friday. So that's why some of these results may be a little bit different than others that you will see. Going back to the beginning of the year, we have the NASDAQ 100, the NASDAQ, and the S&P doing the best. We have the other indexes that are slightly positive, and the small caps, which have been under a lot of pressure, they are negative since the beginning of 2023. Going back to the all-time high, all of the indexes continue to be underwater, with the small caps and then the NASDAQ leading the way lower. Looking at different sectors, we had an up week, so that's how I sorted this. We had tech and communication, which have been the real strong leaders in 2023. They were up on the week and showed the most strength. Where you have staples, they're just under a lot of pressure now. They held up well in 2022. They're really suffering in 2023. And then utilities, which have been pretty strong, they actually, pretty weak. They bounced back up a little bit this past week, and I'll show you some charts of that. Discretionary, near the bottom, it was up, but not by very much. It's kind of the third strongest area that we've been watching so far this year. Then we look at a thing called the relative rotation graph, and you have to remember back to your geometry class, where on the going from left to right, you have the x-axis, and then up and down, you have the y-axis. And when we're going to the right, that's a +1. When we go to the left, that's a -1. When we go up, that's another plus or +1. And when you go down, that's a -1. Well, when you look in the right-hand corner, this is a +1 score. And we're still showing that energy's been doing about the best. And the areas that have been stronger a little bit longer, we have communication, discretionary, and tech. These are showing some weakness, even though they are longer term more positive. We have utilities and staples, which are in red and getting weaker. And then you have some of these other sectors that have been showing some improvement. We've also been seeing a little bit of an improvement and starting to get stronger with the financial sector. We're going to be getting some earnings from these companies and banks and institutions and so forth. We'll have to see if the rise that we've been seeing in the financial sector is justified. Then looking at all the different sectors just for the week, these are for the 5 trading days. We had utilities, tech, communication, and healthcare were positive. Materials were slightly positive. The other sectors ended up being down, with energy leading the way lower. Going back to the beginning of the year, we have communication, tech, and discretionary doing the best. They're positive. All the other sectors continue to be negative, with utilities really being down heavily. The rise in interest rates are really hitting utilities quite hard. Going back to the all-time high, energy, even though it's giving back some gains now, it's still doing the best since that time. And we have a few other sectors which are turning more positive, and then the other sectors still remain negative, with real estate showing the more long-term decline. Looking at sentiment, we did get extreme negative earlier in the week. We dropped down below 25. With the move up that we saw in Friday's session, it came back up to 29. So we look at this historically, where maybe we've set some kind of a capitulation, extreme fear type of situation in the market, and maybe we'll be able to come and bounce up out of this and see some improvement. You know, there's no guarantee. We could just turn and go back down below 25 again, because we didn't really see any kind of capitulation per se. You've got the market really reacting to whatever the economic reports are coming out for that particular day. We're looking at the active asset managers, where they're now starting to get extreme negative. And this could be a good contrary indicator. Even though these folks are professional, they're still human beings. They still do things according to emotion. Sometimes they react to things instead of proact to things. And the fact that they're really dropping to a low level could give some support to the market. And here's another chart of that same reading, where we're dropping below 40. We're at 36.21. Now, just because we're down at this level doesn't mean we're going to stop here. We could still go down further. When we hit the October 2022 low, they were very negative at that time, because they're human beings too. Then we look at the VIX, where it was pretty much flat on the week. It's been a little bit more volatile, but on a weekly basis, it's calming down a little bit. If you look at the bottom with the bar chart, we did cross above 20, but we never closed above 20. And if you use static numbers for the VIX, you use 12 to the downside and 20 to the upside. Well, we're coming back up to 20. Well, that's not very realistic because you can see both on both of these charts that we can get well above 20 and show a lot more fear. So that's why we also look at some dynamic measures of the VIX that I talk about in the deep dive video. The Ulcer Index, which is another fear gauge, it's coming back up to the moving average, showing that there's been a slight increase in fear. The Ridex Bear Bull Ratio, this is also another fear gauge. When this is spiking up, that means that these folks who, again, tend to react to what's already happened, they're getting more fearful, but we're not at an extreme reading right now. Now, one thing to keep in mind, this is as of Thursday's close. It doesn't take Friday's advance into this particular calculation. There's a one-day lag on this chart. We also get the American Association of Individual Investors. Not much of a change. They tend to react to what's already happened as well. And they're down here at 11.5, minus 11.5. So they're more negative. We also follow the 50-period moving average, which has been showing a little bit of an improvement. But as we've been hitting trouble in September and now dealing with October, these folks are tending to have a little more short-term fear, but longer term, they are getting more positive. This is a chart that you have to kind of look at in reverse engineer it in your mind, because when it's going down, that's actually positive. The black line is the tech sector, and we compare that to cash. Well, for going back to 2008, all the way up until 2022, the tech sector outperformed cash. Well, I mean, that makes sense. Then we hit 2022, where the black line started to go back up. That meant cash was outperforming the tech sector. Now we started to drop back down. We've been chopping around a little bit, but still on a longer term basis, the tech sector is still outperforming cash. Looking at the economy, we have GDP. We had another release not so long ago, where when we look at the Atlanta Fed forecasting, we're just a bit under 5% currently. When we look at the forecast, we top out at just under 4%, and then the bottom range is at about 1.5%. This is what we look at for the GDP now on a bar chart, where it's going up and just a little bit under 5% right now. It's showing good, solid GDP looking forward. We also look at this. This is the spread between risky and more conservative bonds, looking at their options. When we get fearful is when this chart really starts to go up. And yeah, it went up a little bit here, but we're talking big spikes. That means that we're running into some real problems now. And so it's not really giving us a warning sign now. We do have the latest reading of the National Financial Conditions Index. We get afraid when we go above the black line, and this past week we declined. So this is suggesting that we're still hanging in there economically. This chart has still not been updated since July 31st. I thought it would have been updated by now, but this just measures the tightening standards the banks are implementing for who they loan out money to. We did get an update here recently with the real-time SOM rule recession indicator. We're not real concerned right now because we're above the black line, but when we really freak out is when we start to go above the red line. We also have an update of the smooth U.S. recession probabilities. The same thing is true here. When we get up to the red line, that's when we're really concerned. We're just down at the black line currently. We also had an update of the Brave Butters Kelly leading index. This is starting to flatten out a little bit. This was causing a little bit of concern, but again, this is a monthly chart, so it'll tell us exactly the right answer, but about 3 months too late for us. But we still want to keep an eye on these things anyway. We had been going up here, which was producing some concern, but now we're starting to flatten out a little bit in the latest reading. Looking at inflation, we started a new quarter at the beginning of October, so we don't have a lot of data in here. We did get PCE later in the week here, and it's showing that we're decreasing overall with the inflation projections. Keeping an eye on the Fed. As of the close on Friday, October 6th, there's a 72.9% chance that the Fed is going to leave rates the same at their November 1st meeting. And to get some context for that, we haven't really changed all that much. The dark blue, that's where we're at right now. We go a day ago, which was unchanged. a week ago, where we've come down a little bit from that, as you're seeing the potential climb in interest rates starting to pick up a little bit more favor. And then going back a month ago, where we weren't as convicted that the Fed will end up leaving rates the same. We also keep an eye on the Fed balance sheet. In June 2022, they said they were going to start depleting their balance sheet, and they're pretty much doing that. We can look at this on a year-over-year change basis, where there are things coming off of their balance sheet. Then getting into our charts, looking at breadth. The top area is price on a weekly chart, where we're coming down right to the moving average. We're not seeing a lot of strength there currently. We're seeing a little bit more negativity. We're dropping below the moving average based on volume. Look at the new highs and new lows. We're not really seeing any improvement there on the daily charts either. We're seeing a lot more weakness here when we look at our 4-week simple moving average and our 10-week moving average. And you can see the red line is really coming down. If we do start to break above previous resistance, it should be expected that we would start to generate some new highs. But really, all we've done now is gone back to levels that we were at not very long ago. Looking at the advanced decline ratio, we're above the zero line and advancing. So that's positive. Accumulation distribution, we're seeing some improvement on the daily chart. This is measuring what's the smart money doing. We're also seeing some improvement here where it's turning back up, but it's still below the moving average. We're still below the moving average on the daily chart too, but it's also starting to turn back up slightly. Keeping an eye on our trend. Are we in a trending environment or a trendless environment? We are in a trend, but it's weakening. And how that's measured is the black line, which is the ADX, it's crossing below the moving average. So that's how I measure a weakening trend. Then we look at the green line and the red line. Which one is on top? The red line's on top, so we would default to negative, even though it's been coming down. But we're also seeing the green line coming down, and we're also seeing a potential weakening trend. But we're still above 20, so we are still in a trending environment. We keep an eye on the Erin indicator. The green tries to measure the buyers, and they're decreasing. The red measures the sellers, and they're actually increasing. And then the difference between the two is the oscillator on the bottom. When we're above zero, we're positive, but we are declining. We're negative on the daily charts. The mass index it did generate a signal on the daily chart, but really didn't do us any good. It's not generating a signal right now on the weekly chart. Some other charts that we look at, we came right back up to this long-term trend line. That's where we're camped right now. We never quite made it down to the 200 period simple moving average before bouncing up. Now we're trying to see, are we going to break above this trend line, or is this going to act as resistance before we start to come back down? And then the last number of days, you can see for the most part, we were above average with volume. We're just about at the midpoint with the trend channel going back to 2009. When we're above this, that's more of a positive bias. When we're below it, that's more negative. I have another chart to show you later that's a little more refined. We look at the pivot points on the weekly chart, which are good for the whole month. Actually, they're good for the whole quarter. Don't quote me on that. But we came right up to this R1 level, and that's where we topped out in July. And we've been having trouble ever since that time. But when we look at the trend, the 50-period simple moving average, the red line's still going up, even though the black line has been declining. So this is still a positive trend. We're also seeing a positive trend when we look at the blue line, which is a 13-week moving average, which kind of equates to a 50-day moving average. And the red line is a 50-week moving average, which pretty much equates to a 200-day moving average. And even though we're dropping down and seeing some weakness, we're still in an uptrend. The McClellan oscillator getting just about back to the 0 point. And we're seeing this same reading on the daily chart, which is kind of strange. Usually they vary from each other, but this is showing some improvement after it had gone extreme negative. The summation index, which gets its values from the McClellan oscillator, we're looking more negative here. We're declining and below zero based on price and volume. The Swenlin trading oscillator, we're showing some improvement based on price and volume, but we're still below zero. So this is still negative. We're seeing almost this exact same reading on the daily chart. We're starting to get extreme negative with the bullish percent index for the S&P 500. This, to me, is a major indicator, and it's one I rely on heavily. What we're waiting for now that we've gone extreme is if we see a bit of a bounce and we start to cross back above 30, that could be a pretty positive signal for the market. But at the same time, we could still drop lower than where we're at right now. The PMO, another momentum study. This is showing that we're going down with the PMO itself. We're declining based on price and volume. When we look at some PMO studies, these are all the stocks inside of the S&P, and then we measure all these different measurements of the PMO indicator. We're seeing some improvement with the rising PMOs. After being slightly extreme negative, we're turning back up with the buy signals. We're starting to go extreme negative with the PMOs that are above zero, and we're seeing kind of the same thing here on the daily charts. The Bollinger Bands as represented by the percent B. This measures when we go above the upper Bollinger Band or below the lower Bollinger Band. We're below the midpoint here, so that means we're more negative, but we're not getting an extreme reading here. All of the momentum indicators on the weekly chart continue to point down. That's negative. We're seeing that exact same thing on the daily charts on all different time frames. Every bit of momentum currently is negative. The Chaikin money flow. This is another measurement of the smart money. It's still positive here, but it ticked back up. It's negative on the daily chart, but it's starting to rise up and get closer to that zero level. So that could potentially be something positive in the background. The Chaikin oscillator, after giving us just barely an extreme negative reading, is starting to bounce back up, but it is still below the midpoint, so it is negative. The force index showing a little bit of an improvement, but is still below zero. That's negative. The money flow index below 50, and it was flat, but it's been declining overall. That's negative. We had a slight up week when we go back, even though we were down. We were up 0.48%. I'm so used to things going negative these days. So we're slightly above the midpoint. But when we go back 50 weeks and look at this, we're starting to calculate some more weakness. But we had come to what could be considered an extreme positive reading, and we're coming down from that. If we start to see more of a recovery on the daily charts, we would expect this to turn and go back up. If we see more weakness, we will expect this to continue to fall. The RSI, we're just barely below 50, but starting to turn back up. So it's negative, but showing improvement. We're getting a little bit concerned about the daily special K chart. It's right on top of the red line where we continue to be negative with the weekly chart. And you can see for the period that I have going back to 2013, this was one of the first signals that we've seen. And we might, on the daily chart, we might see one, maybe two signals that are actually given each year. The Stochk RSI, a momentum oscillator, is still extreme negative and starting to turn up. The Williams percent R, it's no longer extreme negative and showing a little bit of improvement, but they're still negative. The ultimate oscillator is turning back up slightly, but still below 50. The vortex, we saw a week ago where the red line crossed above the green line. Well, that's still keeping things more negative. The Kopit curve, I usually only use this when it rolls over positive and gives us a buy signal, but we could also look at this in a negative way where it is declining. And then this is a long-term fib and really long-term moving average study where we came down a little bit to the 40-week moving average, which kind of equates to a 200-day moving average. Now, we never hit the 200-day moving average on the daily charts. We came down to this level on the weekly chart, and maybe this is the support that the market was looking for. Some different charts. We have a Heikin Ashi chart, which continues to be negative. We're also negative with the Keiki chart. It's red and pointing down. We saw a new block being drawn for the Renko chart. That is negative. It had been positive. And the three-line break is also negative. So on a trend basis, we're still negative. We're seeing some potential positive signs under the surface, but we're seeing almost no chart confirmation yet. The ease of movement, this really has two indicators. The top one is called equi-volume, where if it's green if it's up, it's red if it's down. The thicker the candle, the more volume went into that particular move. That's what we look at to get a graphical representation. Below, I follow mainly the 14-week moving average, where we're below zero and declining with the ease of movement. And this is trying to measure the path of least resistance. Is it to the upside or is it to to the downside, and right now it's more to the downside. We didn't have anything new that was drawn on the point and figure chart. We had a signal that was triggered on September 25th of a double bottom breakdown, and we're seeing that same chart pattern and signal being drawn on the daily point and figure chart. Looking at our trading systems, we're still negative when we look at the Elder Impulse system for the S&P. We're still negative with the parabolic SAR. After Friday's session, we see a dot underneath. So that typically can be positive for the market. But it's also, you have to realize that there's nothing magic in any of these indicators. That's why I use a whole lot of them. Our PPO studies, we're showing a decline in the long term. We're actually turning more negative in the intermediate term. We had gone negative in the short term, but we're starting to show some improvement, especially after Friday's session. Some daily charts that I want to include here, just because all of you don't watch the daily videos. It would be to your benefit to watch them, but I don't know what kind of investing you do. So they're available to you if you want to watch them. David Keller from stockcharts.com put out a chart a week or so ago, and he's suggesting that we're now seeing a confirmed head and shoulders top. We confirmed that when we broke down below this dashed line. I haven't updated this chart. This is a daily chart, and it's really closer, or we came down closer to the 200-day moving average, but we didn't touch it. But this could be longer term negative. This is a chart that is showing the long-term trend from the October 2022 low. We connected that to the March 2023 low and then just extended it forward. Well, we broke down below that support, but in Friday's session, we've come back and we're right on that level right now. So until we can close above that, this is still acting as overhead resistance. We're also coming up close to the end of the 50-day cycle. Now, you can have all different kinds of cycles, 9.5 days, 14 days, 326 days, whatever you want to come up with. Over the last year or so, the 50-day cycle has been kind of helpful to us, where if we look back at what had happened, sometimes it marked a low, sometimes it marked a top, sometimes the market just kept going and didn't even pay attention to it. Well, this upcoming week, we're going to hit October 11th, which is going to begin a new cycle. We don't know if it's going to be up or down, but we don't even know if the market's going to pay attention to this, but we just want to be aware of this. We've also been dancing above and below this 50% retracement level for the NASDAQ. And usually we don't do that. See how earlier in August we came down, touched this, and then shot back up? Well, we go a little bit below, a little bit above, a little bit below. After Friday, we're a little bit above. So it's not really acting as a boing point or a point where we hit it and turn and go in the other direction, at least right now. The NASDAQ 100 had a pretty good day on Friday. We were able to get back above this pivot level, but we still have the 50-period moving average and this previous all-time high for the NASDAQ 100 still above where we're at right now. And we've been chopping more or less sideways. And if we start to come down, we'll be waiting to see if we exceed these lows that we had set. Keeping an eye on the S&P 500, we're coming back up to this 100% retracement level. We haven't closed above that yet, so it's still overhead resistance. Here's another fib chart, longer term, where we're almost back up to the 61.8% retracement level. We have not closed above that, so it's still counted as overhead resistance. Looking at the broad market, this is a seasonality chart where we were down 4.2% in September. Right now, we're up 2.9%, at least historically, 80% of the time in the month of October. But this will have to work itself out throughout the course of the month. Looking at just a blank chart of the S&P, the mid caps and the small caps, we are seeing some weakness in the mid caps, but as well as the small caps. But when you look at small and mid cap growth to value, they're still hanging in there fairly well. The Dow is still in an uptrend, even though we're now dropping below this 50-week moving average. And when we look at the NASDAQ, it's down below this 13-week moving average, but we're still in an uptrend. The NASDAQ 100 continues to be in an uptrend, is now coming back up to this blue moving average. The mid caps, this is where we're seeing some weakness. And we're in danger on the daily charts for the small caps and the mid caps. We're below the 200-day moving average. And unless we see some real powerful upward movement, we're probably going to see a death cross on the daily charts pretty soon. The small caps are still in a tentative uptrend, even though they've been under a lot of pressure. We'll have to see. This level that we're at now has acted as support. We closed up off of that during the week, but we want to see the small caps really doing well, and they just have not been doing well. The NYSE, which is a broader measurement, continues to be in an uptrend, even though we're dropping back recently. All stocks continue to be in an uptrend. The 30 biggest software companies also dancing around the red longer-term moving average. They're in a weakening uptrend, but it's still an uptrend. And the FANG index has come right back up to this blue line, the 13-week moving average. That equates to the 50-period moving average, and we closed just about at that same spot on the daily charts. ARC, which has generated a recent golden cross, but then is seeing a lot of weakness, it's coming right back up to its 50-week moving average. Keeping an eye on the banks, where we're down overall. The MACD is starting to roll over negative. We're below 50 and declining with the RSI. We're going to be watching this. There are some previous support levels on this chart that we're not quite at right now. And some of that may be dictated by the financial reports that end up coming out. When we look at the deposits in all commercial banks, it's starting to show a bit of an improvement. Then looking at Dow theory, this is traditional Dow theory with no studies on here, where we've been declining with the Dow. It's been having a little bit of trouble. The transport's actually having a little bit more trouble, which is not positive for the market. But you can see down here at the bottom, where the utilities have been under massive pressure. Looking at some broad market measurements, this is the CRB index, where we did have a recent golden cross on the weekly chart, but we've been pulling back since then. Oil, which had gone up into the 90s, is now dropping down into the low 80s. Copper is still positive on the weekly chart. We're negative on the daily chart. And this is a barometer of the economy. When we're going up, the economy looks better going into the future. When we're going down, the economy looks weaker going into the future. And we're under a lot of pressure, and we've been declining, and much more of this, and we're probably going to cross negative. The dollar, which has been quite strong, we did drop down below 100, and then we just been screaming up. We got into the 107 area earlier in the week, but this is just based on closing values, and we closed down just a little bit below 106 in the 105 region. Gold we're already crossed negative on the daily chart. And it's just, there's a lot of people out there that say gold is the place to be. And there are times when that's true. But if you try to trade this or invest in this on a trend basis, you've probably been under all kinds of frustration, because we set a high back in 2020, another high back in 2022. It keeps looking like we're going to break out, only to see that fail. And we're seeing pretty much that same thing with the silver ETF. Looking at bonds, we're starting to go down based on price. That is a death cross and is negative. But when you compare stocks to bonds on a monthly chart, it's showing that stocks are outperforming. This was kind of an issue earlier in the week as they were coming up to the potential shutdown for the government, where we were getting a negative result. We were getting a result of 0 when you take the 1-month yield, which is closer to now, and then subtract the 3-month yield. You should always get a negative answer. The 3-month yield should be higher than the 1-month yield. Well, when there's a lot of uncertainty, like this gyration that we saw, that was during the debt ceiling crisis earlier in the year. And as they were wondering about the government shutdown, we came up to 0 for a couple of days, but now it's starting to go back negative. This is a daily chart of the different yields across all the different maturities, just showing how we've been going up overall when you take a bigger picture look at this chart. Then we look at a weekly chart of international rates, where the black line is the UK. Now, a week ago, the US overtook the UK having the highest interest rates. Well, the UK is back in the lead now. I'm pretty sure I'm seeing that the right way. We're also seeing German rates really going up, and we're also seeing, believe it or not, Japanese rates starting to climb. Some relative studies. First, we look at the intermarket analysis chart going back to the beginning of the year, where we're now having stocks turning up and doing better. Oil a week ago was just doing wonderful. Well, it was really down this past week. The green line is the dollar, and gold, which had started to slip negative. It's pretty much a change going back to the beginning of the year, where bonds went negative in August and have been having trouble ever since. This goes back to the beginning of 2022, where oil is still in the lead, followed by the dollar and gold. Then we have stocks and bonds, which are still underwater. Looking at a ratio between the NASDAQ 100 and the S&P, and the big seven, the magnificent seven, the great eight, the wonderful nine, whatever you want to call them, that's where we're getting a lot of our strength from in the indexes. And they're in both of these. They're both in the NASDAQ 100 and the S&P, but the NASDAQ 100 continues to outperform the S&P. The S&P 100, which are the bigger stocks in the S&P, they're outperforming the S&P. And these are signs of strength that we see under the surface. Growth is still outperforming value. That's positive. Gold is really underperforming the S&P and now starting to turn negative in and of itself, let alone in this ratio. And gold is also really underperforming the US dollar. Bonds continue to underperform stocks based on price. Low volatility. This is really going down, and we really haven't exceeded this low. We're still waiting to see. We came down to this before, started to bounce back up. Now we're right back down here again. Is that going to continue to drop? Looking at discretionary, which is having a good year, especially when you compare it to staples. This past week, discretionary didn't do all that well, but staples really did bad. So we're seeing this ratio continue to go up. That's more helpful for the growth area of the stock market. We compare energy with the tech sector, where energy had been starting to outperform, and then it took a big dump this past week. And longer term, we're seeing where energy is underperforming the tech sector. We look at some secular and cyclical studies. These are the long-term positive seasonality and setups that I talk about in every daily video. We're back in October 2022. We had an extreme negative reading, and this popped up, and that is an indefinite buy signal, and this is called the NYSE breadth thrust. We have a similar indicator, which was triggered back in March. This one's a little more confusing. It's called the ZWAG NYSE breadth thrust. When it goes down here and then shoots up really fast, that's a signal that I think we don't get very many of these signals. I think this is also indefinite because we've been dropping back down to these extreme negative readings again. Does that negate this, or are we waiting to see if another signal will be generated? This is the Zahorchak method, and think of this as a binary signal. It's either giving a buy signal when it's on the top or a sell signal when it's on the bottom. There's sometimes when it kind of stops halfway here, but this is still positive longer term. This is also going back to the 1987 crash, a long-term trend line, and we're still having difficulties breaking above that for the S&P. This is what I referred to earlier with the trend channel. This is more of a refined measurement where we're right on the trend line right now. So that's marking some indecisiveness. This is a arithmetic scale. And I always joke about this. People want to say arithmetic. It's arithmetic. What did we call it in school? Hello, teacher. I need to finish my arithmetic homework. No, we say arithmetic. And I always like to make fun of that. Then we look at another weekly chart of the S&P, and based on the log scale, which is not arithmetic, where we're still well below this long-term trend line. And I talk about this in every daily video. I also talk about this where we're below the trend line for the NASDAQ 100. This is another one. I don't mention this all the time. This is a ratio between the NASDAQ 100 and the Dow. And when we topped out back in 2000, all the way leading up, that was the dot-com boom. Then we started to go down. That was the dot-com bust. It took us 20 years to get back up to this level. We hit it again right before we ran into trouble in 2022, fell back, and now we're starting to come back up. And we haven't got back up to this previous high, at least yet. This is a newer chart where, depending on what you use, if you use indexes to do this ratio, I don't have that ability at stockcharts.com. So I have to use ETFs that represent indexes. And this is a ratio between the QQQs, which is the NASDAQ 100, and the IWM, which is the Russell 2000 small caps. And back here, we came up to a really high reading and then saw a lot of problems after that. Now, if you look at the indexes, we've already come up to this blue line, but we're not seeing that when we're looking at the ETFs. There are slight differences between ETFs and the indexes that they track. There's some skewing that goes on there. So we're just keeping an eye on this to see if it does go up to the blue line. Some momentum studies, we look at the MACD. I'm really just showing this because of the MACD now, where we continue to be in a downtrend. Earlier in the year, we were trying to figure out if this break above the trend line was for real. And so much time has passed now that it's pretty much irrelevant for the time being. So what's our outlook for Monday? And this is based on the daily charts. The Treasury market will be closed in observance of Columbus Day. The stock market will still be open. So it's one of those pseudo holidays. Earnings reports will begin to come out. Other ones from the last earnings season might still trickle in. The UAW strike is still continuing. They're still trying to figure out what to do about a new Speaker of the House. That can cause some political instability. The technicals are negative, but improving. Remember, this is the daily charts. We are in a confirmed downtrend in the short and intermediate term and still working off of being oversold. We won't get any economic reports on Monday, and we're keeping an eye on all the different geopolitical events. I should add one here. I'm waiting to see how it plays out, but just before I started recording, there's problems going on in Israel where Gaza has attacked Israel, and it says the last thing I saw, Israel is on a war readiness. So is that going to be a short-term skirmish? Is that going to develop into something longer term? It may affect a trip that I'm planning on going to in November, in the early part of December. I plan on visiting Israel, but that's a personal thing. And a lot of times these skirmishes that we see don't necessarily have an impact on the stock market, but you never know. Here is the economic calendar for the upcoming week. No reports on Monday. We're going to get PPI on Wednesday, CPI on Thursday, and consumer sentiment on Friday. The Stock Traders Almanac statistics for Monday, October 9th. We're neutral to negative with the Dow and S&P, where we're neutral to positive with the NASDAQ. This is also a seasonal pattern chart. Now, this is a little bit different. The green line in here, this is when a sitting president is running for re-election, where we're kind of choppy in here now. We're wondering if we're going to see some more of a bounce. But historically, we've also seen weakness going into the end of October, seeing kind of that same thing with the Carson chart, which I showed earlier. And then this is a chart of the NASDAQ where we might see a bit of a bounce before we see some weakness. It doesn't mean this is going to happen. This just means that when you take all the years together and average them, this is what has happened. And then looking at the S&P, also seeing a bit of a bounce up and then possible weakness later in the month. And then this is a pre-election year, just looking at October, going back to 1950, where we've been up 10 out of 18 times and down 8 out of 18 times. So there's a slight up advantage in the month of October during a pre-election year. Looking at our scenarios, we're still going with the down scenario on the daily charts. The technicals are clearly negative, but showing some improvement, but we're not seeing a lot of an improvement in our charts. We're not going with the up scenario. We just don't have the confirmation of that. And we're not going with the sideways trend because both our short and intermediate term ADX indicator are above 20. The warning signs, the long-term trend lines that I showed for the S&P and the NASDAQ 100, we're still below that. And for right now, we have to say maybe that's signaling a top unless we can go back up and break through those lines. Seasonally and historically, October is better than September. Any month is better than September. The equity put call ratio, which is based on a 5-period simple moving average, that's going up, but it's also extreme. So we're waiting to see if that's going to turn and start to come down. Sometimes that will mark a bottom for stocks. The longer term, we have a 253-period moving average of the equity put call ratio. That's continuing to go up. It's positive when that chart goes down. All of the daily oscillators for the S&P are negative. The NASDAQ 100 oscillator that I follow is negative, but it could be getting ready to cross above its moving average. The cumulative new highs and new lows for the NASDAQ continue to show weakness. That's gone on now for a few years. The 3-month yield is still above where it was back in 2007. We're waiting to see if that 3-month yield is going to roll over and start to come down. That's what it did right before the great financial crisis. If it does really start to come down, interest rates are still going up for right now. So we're not even close to a signal. But if it does start to come down, that might generate a warning sign at least. The 50-period new highs and new lows exponential moving average, it was positive for pretty much all of 2023. This past week, it's now switched over to negative. That's longer term negative. The Russell is below its 200-day simple moving average and maybe getting ready to generate a death cross. And we're wondering on the daily chart, is a head and shoulders top pattern forming? I talked about the S&P 500 head and shoulders top. There's also one with the Russell 2000 index. The vortex is negative for right now, both on the daily chart, now on the weekly chart as well. And then we're dealing with earnings season. But there are some positive things. The seasonality and setups with the NYSE breadth thrust, the Zahorchak, those are still positive. The daily special K chart is in danger of turning negative, but it hasn't quite done so yet, where the weekly chart is already negative. And this was new after Friday's session. The parabolic SAR daily chart has turned positive. The S&P is still above the downtrend channel upper line. I'll be going over that chart in the deep dive video. The risk on posture overall has been showing some weakness, even though it bounced on Thursday and Friday. The Staples to S&P 500 ratio is declining. That often gives support to the S&P as well as the next one. The S&P to utilities ratio is going up. That means that the S&P is outperforming utilities, which is often positive for the S&P. The Russell, the small caps, and the mid caps are in danger of losing their recent golden crosses. Small and mid cap growth continues to be positive. The financial sector is also below its 200-day simple moving average. The longer it stays below that, the more likely we might see a death cross in the future. So our conclusion, we're negative right now. And again, this is just based on daily charts for Monday session, but we are showing some improvement. We're in a confirmed downtrend. In the short-term trend, we're still working off of being oversold, but showing some improvement. Intermediate term, the trend is negative as well. We're a little bit oversold there, but also showing some improvement where we're still positive in the long term because we're still above the 200-day simple moving average. Thank you. I really hope you found this helpful. I hope you're having a very nice weekend, and I will talk to you in the next video, which will be the intermarket analysis video.